Good morning, everybody. It is Friday, January 14th, and there is a crazy amount to talk about. I'm going to go through some of the things that I'm reading, go over some of Shooter's stuff, and I'm going to try to fly through this. I'm going to show you part of the presentation I did for the Money Show, really talk about why you need to be aware of what I'm talking about, how you need to understand Fourth Industrial Revolution, sustainability, tech, everything that it encompasses, because we might be getting a monumental buy low chance here in the next couple of months. Something I've been warning about, for a long time is we've been overvalued. Liquidity pumped up asset prices, and now liquidity is going away. So what does that mean for asset prices? There's just a whole lot to talk about. So let's start with some housekeeping. On fundamental trends, if you remember, on the sidebar, you can get all the articles to come to you by email so that you're notified. Only about half of you are doing that, so you really should. You could also have your browser alert you when you open your browser. And either one or both, I think probably both is the way to go. That way you know when I'm putting up new stuff. We got 4 or 5 new articles a week for me starting again this week. Shooter's got 3 or 4 articles out a week from his trading notes, the major markets, ETF risk on, risk off, the crypto tracker, which we're going to launch as a paid service here probably in the next month. So start understanding this if you want to trade crypto. The one thing I will say about trading crypto, it is so technically pure on the trades. What do I mean by that? What I mean is that the trade setups are just pretty much straight following the technical indicators, because nobody knows how to value it fundamentally. You just know that it's going to go up over time with Bitcoin and Ethereum. So, how do you buy? Well, you create your channel and you buy the bottom of the channel, you sell the top of the channel. So if you want to trade this, I tell you what, Shooter the other day when Bitcoin was like 39,000 and change said you ought to start scaling into this right now. So I did. So I went on Coinbase and I bought some. And sure enough, it went up to 44,000 like 2 days later. And it didn't quite make the 47 mark. And it's come down just because of the general market problems. But I tell you, if he's right and we get a run at 29, 30,000 on Bitcoin, that might be one of those rare double bottom opportunities to load up on it. So open your Coinbase account, is at the bottom of the page. Just click on here and go to Coinbase, and you get $10 for free when you put $100 in. I get $10. Ooh. I said I probably wasn't going to buy a Bitcoin, but I decided to follow Shooter's signal and I bought it, and I'm up. But I'm looking for that other opportunity. I did the interview with Dr. Sean Stein-Smith last week. It's half edited. I'll finish the edit this weekend. And some of the things that we talked about are going to blow your mind, because he had me stuttering and I had to edit out my stuttering. The whole transition that Amazon kicked off with certain stores closing and stuff moving online, that's going to accelerate. It is weirdly going to move into the metaverse, where you can, as Shooter talked about off air, you can just go online and shop in 3D at Walmart. And Amazon's going to have it. They're all going to have it where you don't have to go anywhere if you don't want to, which is why I've been saying that the shopping malls are so doomed. Why I hate Simon Property. I think that unless it's an experience-based mall, or has a lot of residential and other types of commercial business and restaurants in particular, you got to have great restaurants. The malls are going to get creamed again. So it's just so much is happening in tech. It's kind of mind blowing. So anyway, follow along by subscribing to the emails. And if you want browser notifications, I don't really use browser notifications, but I know some people like it. You get a little follow here. So just follow, put your email in. All right, some other things. Technology. I have all sorts of CES sessions that I'm going to go through over the next 2 weeks, and I will save some and I will load them onto fundamental trends. I think I got to figure out a way to save these without breaking any rules. But I will get you some of these. I'm basically watching them while I play online poker. Did the money show this week. I have a whole bunch of presentations to go through here for you. So I'll give you the good stuff, and I will let you know when I'm watching them in case you want to watch along with me. I'll put them on Zoom and I'll record them, the good ones anyway. And like I said, I'll figure out a way to create some sort of a library. So one of the things I subscribe to is FS Insight. That's Tom Lee. You probably see him all over TV, spend an obnoxious amount of money on this service. And what I'm doing is sharing with you again the best stuff. So he has an article in here called Signal from the Noise, or Signal from Noise, every week. Actually, it might be every day. And it really covers this whole parsing out, throwing out all the stupid narratives. Remember, I've told you over and over and over again how the traders have narratives and how they're dumb narratives. And they're just 80% of the time, they're just hot air to make you think that there was a reason for a stock to move. Look, the reason why stocks move is almost entirely liquidity based. Almost entirely liquidity based. What do I mean by that? It means that if it's a low float stock, if it's a small cap stock, it's one of these D-SPACs or a micro cap or something under a couple $1 billion, it means that when the traders have cheap money, when they can get leverage, when they can use margin for cheap, they can gang up on stocks and they can drive something down 30, 40, 50, 60, 70, 80% because they just keep shorting it. Or they can pump it up, double it, triple it, quadruple it. Why? Because they just use margin to buy calls and they create this cycle. And either way, there's a spiral up or a spiral down. Ultimately, there's a top and ultimately there's a bottom. And in the D-SPACs, right, the SPACs that have gone public, we have seen a lot of those bottom. I mean, Black Sky is down 70% from the IPO and I think 80 or 90% from its high. Same thing with Spire Global. Even Planet Labs is way down. And you go through these SPACs and you're like, they're not just trading for book value in a lot of cases. They're trading for almost their cash value. Think that through. Companies that are valued at $3 and $4 and $5 and $600 million are sitting on balance sheets with $3 and $4 and $5 and $600 million, and they're close to being break-even companies already. What is going on there? It's because a lot of these companies aren't on any indexes yet, and if they're not on an index, they don't get into the ETFs. What's EFT? Is that a space thing? I don't know. Yeah, it's something. I said it. It's something. So if it's not in an index, it doesn't get into the ETFs. As a lot of these companies get added to the Russell, which happens in April, May, June, or May, June, July, I think it's April, May, June, then institutional money will come into these stocks. And that changes the whole liquidity equation. So between now and April, I have that list of, 10 or 11 higher risk stocks. If you own them now, don't freak out and sell them at the bottom. And if you don't own them, you should really think about, should I have 10% of my stocks in this high risk sleeve? Because the answer is probably yes, if you want to have some triples and quadruples and 5 baggers and 10 baggers over the next 3, 4, 5, 6, 7 years. Because most of these companies are going to make it. And the ones that start having financial problems will dump. But Planet Labs, a member was good enough to send me the brand new Goldman Sachs report on Planet Labs. Goldman Sachs slapped a $11 price target on Planet. It's trading for $6 right now. It's a 2% position for me. Spire Global was a 2% position. Now it's 1. I haven't added to it yet, but it looks like I'm probably going to. CFV, which is Satellogic. A lot of you have tendered for that, and that's fine. You're going to get your $10, but you should be looking for an opportunity to re-enter. I'll write about these satellite stocks again. They're just super opportunities to make 10 times your money on these from the bottom fishing prices. And some, 3 of them are below the bottom fishing prices. CFV is probably going to fall. They're getting new financing. So many people tendered. I think after seeing how the other satellite stocks got beat up, basically everybody just took the $10 and the warrants. And so after CFV, Satellogic goes public in the next month or two, that stock probably goes down to 7 or 6 or 5 as well, because the new pipe is going to dilute them. because they had to get new financing because so many people redeemed. Volatility is interesting. I will do a little report on this. If you're over in the chat room on fundamental trends, you know that Shooter talks about volatility all the time. And we're probably going to have a peak volatility event this year, or two, probably two is what I think, soon. And then again at the end of the year. And then you're going to get a couple of years of volatility falling. And there's some neat trades that we can do that are, 2-3 year trades where as volatility collapses, you can make a ton of money, just passively holding something that's anti-volatility. So we'll talk about that over time. Tom Lee talked about how QQQ was starting to get beat up, the long consolidation pattern. One of the things that I would show with QQQ is that when you take a look at it by market cap, a lot of stocks are pretty overvalued. So this column here is 5-year price to free cash flow. And you can see that Apple and Microsoft are still expensive. When they get into the middle, that's when you start looking at the rest of the index. Do they get down here again to where they were, where they're the low end of their free cash flow, the price ranges? Hard to know, but right now they're high. One of the weird ones is Amazon. You see how the prices come down, but this is way out here. This one is skewed. This is where knowing your companies comes in handy. Remember in the fourth quarter, Amazon said, hey, we're just going to spend everything we have to make sure everybody gets their packages. So it looks like the price is high relative to free cash flow. That's because the free cash flow shrunk. They really pulled it down basically all of last year. So it's skewing this whole equation. If we normalize it for the future, it's probably in here somewhere, more in that third quartile, but still not cheap. Probably similar to Apple, actually. Tesla, actually getting kind of cheap versus cash flow. The question you have to ask is what's going to happen to their free cash flow going forward? Is it going to go up or down? If they have to build more factories, it probably, right, not a great equation. It hasn't come off as much as I think it can come off. It dipped and it rose a little bit. If I had to guess, I still think a price for Tesla under 700 makes a lot of sense to me. Their market cap should not be $1 trillion. Ford just hit 100 billion again for the first time in whatever it is, 13, 14, 15 years. Why is Tesla trading for 10 times more than Ford? I don't know if Ford is supposed to go to 300 billion and Tesla down to 300 billion. I'm not really sure how that equation works, but Tesla shouldn't be worth more than Ford and GM under any circumstances. So that means that Tesla has to come down and Ford and GM have to rise, because the technology at Ford and GM is every bit as good as Tesla, and I would argue better. And they have the ability to use their real estate to take their fourth industrial revolution technology and get into other businesses and really benefit from supply chains coming back to America. So I'm actually even thinking about buying GM if we get a low enough price. In any case, when we start to see price to free cash flow come down here, and this is the basket of stocks that I'm just kind of going through right now, you take a look and you say, wow, Zoom and DocuSign are pretty cheap. And I didn't put them on the plug and play, but they might be midterm additions, because Zoom is just going to keep getting better because they keep improving their platform, and they're not cheap. I mean, they do not price it cheap. And they're adding VoIP service. So, if all of a sudden Zoom is a more complete enterprise solution, they compete with Cisco and Microsoft at that point. And does Microsoft or Cisco just say, screw it, we're buying them? If they get cheap enough for a hot minute, they might. DocuSign I've been using since it was private a long time ago at my brokerage. And I will tell you, this $25 billion market cap is way too small, because before everything goes NFT on contracts, you're still going to have to sign stuff, and digital signatures are becoming legal tender everywhere. DocuSign has a pretty good platform, and it just keeps expanding in the financial industry and other places. So I think you probably see over the next 3 to 5 years, DocuSign get back to their high. So that's about a triple, $7,500 billion. Why? Because it doesn't take a lot of CapEx to support this company. And as it continues to spread with very limited competition, it's a service company, a software as a service company that can do pretty well. All right, so let's jump back to the broader QQQ, Shooter has some charts, and you could take a look at his risk on, risk off report every week at Fundamental Trends. And then I'm adding these charts to the Global Trends article at margin of safety. The QQQ, where's the weekly? Right, he's got one of his boxes down here in the middle 300s. Mine's a little lower, but I understand the argument for up here. That price right here in October, if it gets back down to that October price and the Fed is continuing to talk semi-tough but not acting any tougher, then it might hold. I don't think it holds. I think we get a wave down. I think we get a rebound. I think we get another wave down. That's what I think. We shall see. On the monthly chart, I believe he's got a monthly chart up here. Here we go. This coincides with the bottom of my box. I really think this is probably where we're going sometime this year. Although this is possible. It can hold. It can hold. It could hold. But I think it gets through this 350. Gets down here probably. If you take a look at 2020, this is the repo bailout run up. And it seems to have created kind of a line in the sand. I don't think the Fed lets things get below here before they start pumping money back in. And remember, they have $1 trillion sitting on the side. Even if they end QE, they've created $1 trillion facility for the repo market. And this is what happened when they bailed out the repo market last time. Money still got into the asset markets. So I think this is a pretty hard line in the sand down here. So if we get some epic collapse, you sell your children, you rent out your house, you live in your car, and you buy QQQ. All right, let me show you the presentation that I did at the Money Show. All right, so just wanted to reiterate our 4-step process. Identify the strongest secular trends, understand government and central bank policy, dig into industry and company fundamentals, apply technical and quantitative price analysis. I know that a lot of people love to think about trading. I'm just telling you, if you're not really taking some time to understand the technicals and the quantitative, even if you're not doing primary research, just so you can understand what we're showing you. If you're if you read Getting Started with Technical Analysis, if you read Prechter's book on Elliott Wave, right? I'll put links to both of them out there again. Then you have started to do the work, right? These are weekend reads. If you're going to trade, you have to put some effort into learning the language, basically. And even if you don't want to spend time doing your own charts, and you just want to say, okay, I understand what Shooter said there. I understand what Crook said there. So we're going to take that trade. But for investing, this is still important too, because when we use the longer term time frame charts, the weekly and the monthly charts versus the daily and hourly charts, we know sort of where the bigger bottoms are. And yeah, I missed a lot of the bottom because of COVID, because it was just a whole new thing. But system works. It's made me a lot of money. It's made Shooter a lot of money. He does it shorter term. I do it longer term. Swing trades versus position trades. Pick the one you want. Either way, you should understand how the basic relative strength index and money flow index and shaken works, and understand basic things like, what is a divergence? Well, a divergence is when price goes one direction, but the technical indicators go the other direction, and you're getting a signal that something's about to change with price. Pretty simple. As long as we're staying within the strongest secular trends, though, even if we screw up on an entry, time will usually fix things for us just by being on the right side of the big story. Well, one of the big stories, or two of the big stories, technological advancement and sustainability are the fastest moving things out there. Biggest secular trends by far. There's nothing else out there that compares to these two things. These are the two dominant themes for the next 20 years, probably. For you as an investor, forever. So what is the smart everything world? 5G, IoT, AI, it's the intersection there. It's what one CEO called the perfect marriage. So everything comes from connectivity, communication, and intelligence. That's a way to understand it without lingo. Connectivity, 5G, fiber, and soon from satellite. Communication, it's all the computers talking to each other, all the devices talking to each other. It's your cell phone talking to your Nest, or you start your car remotely. It's your car driving down the road talking to other cars, talking to the signals, talking to the sensors. It's the buildings talking to their control systems or HVAC control systems, which in turn talk to the utility maybe. It's the lights on the road, knowing when to turn on and off based on a sensor that has a central control that monitors data to make sure the lights actually turn on when it gets dark. It's all these things. It's the doctor's office, all these devices talking to each other, which have been normalized for us over the last decade, but really is relatively new. Pretty soon, I'm looking out a window right now, pretty soon the roof is going to tell us when it needs to be replaced. It's going to be all sorts of stuff. And intelligence, the ability to take all of that data and synthesize it into something useful. So that's where the AI comes in. And all those things on the right-hand side, and when you smush them together, that's the fourth industrial revolution, 4IR, something that you need to try to wrap your head around because everything is changing. The ability to shop in 3D with a headset versus actually going to the store, kind of amazing. I don't know how services are going to manifest in the future, but I do know this, the remote concept, the ability to do things without leaving your home is just going to increase. Got a friend whose daughter, unfortunately, is missing a gymnastics meet this weekend because she got COVID at school, has been ordering Chick-fil-A DoorDash like 3 times a week. This whole trend towards traveling long distances, but then when you're at home, you just sit at home, right? I'm going to travel, but then when I'm home, I'm just going to sit at home in my pod. It's weird to me how it's developing, but we need to be aware of it. And it's going to come from how all this technology is used and what we accept into our daily lives. Is everybody going to have a virtual headset at some point? I'm sure it'll be the Christmas gift of the year in the next year or 2 or 3. Should we be putting these headsets on little kids? Man, I really hope not. I really hope we're not giving virtual reality to little kids. They need to see and touch and feel. They need to get out there and skin their knees. So it's just my warning to you while we're making money on some of this stuff, as parents and grandparents and aunts and uncles, instead of playing a video game with a kid, throw a football at them, whatever the case might be, take them fishing. This is a note from Salesforce. Salesforce wrote this note. So fourth industrial revolution is the fusion of the advances in AI and robotics, the IoT, which we talked about, genetic engineering, right? We have a company we're invested in for that, quantum computing and all of it. And it's where the money is going. These are the 6 richest companies in the stock market. That right there is 1/6 of all the money that all the companies in America have. So 6,000 companies, these 6 have 1/6 of the money. What are they? They are platform companies and as-a-service companies, right? Apple is probably both a platform and as a service, right? Apple has the App Store. Google has an App Store. Amazon, right? That's a platform connecting businesses with consumers. And there's a lot of overlap here. You can argue that most of the platform companies offer services, and then most of the as-a-service companies also have platforms. I've got these broken up as to what I see them primarily being, but the difference is dissipating. And the reason why these companies make so much money, again, it's because the capital inputs to make more profits are not that high. When they put in $1, they might get $8 out. Versus when you're making a widget, you put $1 in, you might get $1.25 out. Very scalable, high margins. That's why we buy the corrections here, because those are the rare opportunities you can buy these companies cheap, where the growth rate versus the valuation PEG ratio makes some sense. These are some of the companies I've been in early in their careers. That's why I'm dismissive of a lot of things that people say to me. And again, I promise to try to be nicer about that, because I'm not always nice. It was part of my turning 50 thing. And then when I turned 50, we got COVID. So I'm having breakfast with one of our members on Wednesday, who's a good friend of mine. And I think he could tell you, Mr. No Crying in Baseball, he could tell you that I get a little crabby once in a while. It was my release was like getting kicked out of baseball games. But in any case, where are the opportunities now? Where are they coming? Well, we can buy the large caps. We can buy QQQ, or there's a similar index that includes some S&P companies that I outlined in the plug-and-play ETFs on the dip, right? Get your quality. But really where there's blood in the streets is small caps, and especially the SPACs that have gotten beat up. Just very unusual opportunities to buy things that might be worth $10 billion or $20 or $30 billion in the next decade, but they're trading for a few hundred million. I mean, this is literally like buying Google, Amazon, Apple, Microsoft, when they were tiny. And these companies maybe don't grow that big, but if they go from 300 million to 30 billion and on the S&P 500, that's a 100-bagger. You don't need many of those to have, I'm going to screw off for 5 years of my life money, which is kind of what I've been coming off of during COVID. I screwed off from 2016 to 2019. To me, screwing off is just working a regular 40-hour week. Now I'm back in the saddle and working 60 again. And tell you what, with that AI thrown in and some strategic subscriptions that I have, a couple dozen of them, what we're going to be able to accomplish here, if you follow along, you don't ask me so many what you think questions. Follow along, understand the message, understand how we're getting there, and you might have 5 times more money by the end of the decade. Technology happens to be at the core of sustainability. Clean energy's future is now. It's being driven by technology, industry, utilities, and government. Take a look at this chart. Coal is getting destroyed. Renewables are the fastest growing. Natural gas actually just started to kind of level off, but it was eating the coal generation largely along with the renewables. What you're going to see in the next decade, first natural gas will level off. It's already started in the last year. Then eventually renewables will eat into natural gas. That's going to take a little longer. It's not going to be 2 years. That'll be more 10 to 20. But for the next decade, renewables are going to wipe out coal. Oil is going to have to be used for transportation. So all the countries that burn oil for energy, that's going to stop. And as we electrify and energy usage turns up just a little bit, that'll all be renewables too. How do I know? Because it's already happening. Solar and wind are 70% of new generation. And that equation there where the wind is 31 and the solar is 39, that was the other way a couple of years ago. You notice that there's a little blip with the nuclear. It's because after 20 years, we finally brought on a reactor in Georgia, I believe, or 2 reactors in Georgia. There's like nothing else in development. So even here, you can see that the natural gas is not where the utilities are going. This is utility scale electricity. And the commercials companies, they're all going solar as well because why? They put it on top of their buildings. And it's not just clean energy we have to pay attention to. One of the companies we're involved in has to do with agriculture and carbon capture. So combining agriculture with energy. But these are the things that the United Nations has identified as where we can get rid of carbon. And it's 6 sectors, all pretty even. Transportation, that's the EVs, smart cities and buildings, right? If insulation and monitoring HVAC systems and things like that. Energy in general, produce, what kind of energy, how are we going to produce our general energy? Industry, think about how much carbon there is in cement and metals, better ways to do that. This is actually one that Bill Gates talks about all the time. And there are actually a couple neat solutions that I think we're going to see come online. You want to say 2 years, but it's probably 10. So we'll keep an eye on that. The agriculture, right? If you can take the waste from orchards and from farm fields, if you can go to non-tillable, right? We can cut carbon by a ton and still get to eat our farting cows and farting pigs. And then nature-based solutions. This is basically forestry. It's a big deal. We need to stop chopping down the rainforests. In the United States, we've planted a ton of trees the last 20 years. We need to plant more. We need to find a way for the roofs to either be solar or green. We need the roofs not to be dark colored. We need them to be white or to actually absorb the sun. A lot of things that would go up here too. But I would argue that the cities, because of the nature of the way sales and retail are working and the way walkable residential neighborhoods are becoming a thing again, and we're moving away from the explicitly car-centric cities, the big redevelopments are going to be to take a city block that maybe had 12 buildings on it and put 4 buildings on it that are more vertical and have a lot of green space. So the intermingling of the greening of the planet and how we operate our cities in the future, I think is going to be a major trend for the rest of this century. And I say that because, I mentioned it a couple of weeks ago, we can't stop climate change at this point. It's too late. We're not going to be able to hold the line that we're trying to hold. Water levels are going to rise. Storms are going to continue to be bad. We need an extended period of time where we're putting out about as much carbon as we were when we were in lockdown. not a few months, like I'm a few decades. So as an investor and as somebody who cares about my children and grandchildren, great grandchildren who I'll probably meet if I don't kick the bucket, there's a lot going on there. I know Shooter talks about this. The reason he's working is to make money to plan for climate change. That's why I'm doing it. I don't have to work. I really don't. But I want capital because I think that the redevelopment of the planet is just beginning. And if you have friends and family that you can pool money with for real estate investing in your community, happy to talk to you about some ideas, because I think that buying dilapidated property that's at the edge of nice areas and start bridging into, right, keep the gentrification going, I think that's probably very good for society and the climate. I think there's lots of money to be made there because renters just aren't going away. So you can find that balance. In any case, I mentioned earlier power consumption would tick back up as we electrify the economy. You notice over the last 10 years, and this is Germany, and this is the way that the United States is going to go, is probably very similar to Germany. Their electrical consumption was pretty level, right? This is the Great Recession. This is COVID. Pretty level to even trending down. But now that we're making the cars electric, there's argument that it'll ramp up a little bit. And then all of that production of energy will be, oops, I lost it, will be alternative. So why not just jump in and invest right away? Because stock market's over leveraged and overvalued and just starting to come down. Two of the companies that I talked about for CES are companies you know well. Ford. If Ford gets back under 20 and you don't have a position, get it. Whether you're retired or not retired. So it's paying a dividend and it's going to buy back shares. So not only is it, I think, a great growth stock that could catch the attention of the millennials when, not if, when Ford says they're going to be 100% EV and hybrid, stock's going to go crazy. They already said it about Europe. 2027, Europe will be 100% EV and hybrid for Ford. And they're saying either 2030 or 2035 for America. When they say, and remember, everything I've told you about Ford has come true the last 2 years. Every single thing. The next thing they're going to say, and I think it'll be the end of this year, but it might be next year, is they're going to say they're moving up their timeline to be 100% EV and hybrid. And they're going to say it because the Lightning and the Mach-E are selling out. There's no reason for them to have internal combustion engine cars anymore. So my guess is that they pull the timeline up to 2027. And in the meantime, they're basically going to get rid of everything but the heavy vehicles and a couple sports cars that are gasoline. How does Ford measure to Tesla? Tesla's worth 10 times more market cap. It doesn't make any goddamn sense. So maybe Ford goes up 5x from here and Tesla gets cut in half and then they're equal. Major support down here on Ford in an Armageddon scenario. So if it breaks the stop at about 1861, probably going to see a lower price. I don't know if it's going to break that stop. I tell you, there's a lot of people that love Ford, and I think they're going to buy the dip. So the market would have to get pretty bad, I think, to break this stop, but we'll see. SunPower, these guys are one of the top companies in the space. They're backed by Total, who's the majority owner. This triple bottom with the weak market probably means it goes lower. So if we get a price down here in the lower teens, that's your backup to truck price. Shooter said the exact same thing. He got to it by Elliott Wave. I got to it by quantitative factors on money flow. When his charts and my charts agree, I think that's probably pretty freaking powerful. So just in case you missed it, I threw this one, right? Why Ford? Built-in customer base. Mach-E and Ford F-150 Lightning are selling out and they're adding capacity. They have better technology than almost anybody in the world. They have real estate that they can use for a lot of other things as supply chains move, because you only need half as much space to do EVs as you do ICE cars. So as they close transmission plants and wherever else they're going to close, that's going to be a footprint, a real estate footprint they can either just lease out, that's extra money for them, or they can start getting into another business. There's EV tax credits and potential carbon credits. I've told you about how the guy who bought my campground made all his money in carbon credits in Europe, and the millennials like this company. Millennials like Ford. SunPower, implicit backing of Total Energies, growth rates in the 30s, possibly 40s, expanding margins with a shift away from manufacturing panels. Energy storage and management could be massive. They're partnering with the Department of Energy on a project in California. Basically, that has to do with microgrids. That would be industrial parks or neighborhoods or condo communities having their own solar array and generating their own energy. There's all sorts of tax credits and more coming. And millennials love sustainability. So back to here again, if you get a chance, take a look at the Ford announcements they've made recently. There you go. Ford is already the number 2 EV company in America. Overnight it happened, right? They launched the Mach-E and the F-150 and done. They're already number 2. I am telling you, they're going to outsell Tesla. I just don't know how many years it's going to take. And this is a favorite of some big time investors. That's why when there's a dip, it's not usually a big dip. Again, the market could just sell off and then you get a rare opportunity. This might be one of the safest companies to buy, I think, for a dividend investor who's also looking for growth. And then the SunPower, you could take a look at their website and see how, right? Not a lithium battery every time. When you don't have space constraints, you can do neat things with energy storage. That's why solar plus batteries are crushing fossil fuels, coal in particular, and they're even beating natural gas at this point. And that equation is just going to keep spreading out. And take a look at their slides. They have a new one coming out in 2 weeks. 2 weeks, I think it is. All right. 2 funds on the very short list on the plug and play. This is a market cap weighted index for alternative energy. And then PBW is more equal weighted, right? They perform pretty much the same. They spread out way back here. Just look at the last 5 years, though. They're pretty much on top of each other. Pick the one you want. I favor the smaller companies because I think that the whole small companies trailing is about to flip. For many, many years, small companies led. Since the Great Recession and the QE age, the big companies have led. Why is that? It's because the big companies get more free money. If we are getting to a point in history where there's less free money for the big companies, the small companies will outgrow them again. So PBW is more favored to the small companies and QClean to the big companies. And we can compare this to SPY or QQQ as well, right? The trend's not going to change. More volatility for sure. Since about 2018, sustainability just keeps opening up, especially now that the millennials who decided in 2020 with the COVID crisis to start investing, the millennials favor this stuff. SPY is the last thing you want to be in. I had somebody say they were quitting my service to buy SPY. I was like, okay, whatever. Kiss my ass. You haven't been listening. Don't tell me that you know what you're doing if you're not listening to this. Nobody should own SPY. Nobody. All right. Any questions? Can you hear me? Okay. All right. So no questions. I have a lot to look at and a lot to do this weekend. My girlfriend's gone for a couple days, so I should get a lot done on Saturday. And today I have a client appointment, and then I'm taking Hulk to the museum because I haven't seen him in 3 weeks, and it's driving me nuts. And seeing as I don't have one of my dogs anymore, I just need some kid time or doggy time or something. Maybe we'll go to the Humane Society. I don't know. All right, everybody, have a good weekend. Don't get itchy trigger fingers. Don't panic. You should have been accumulating the cash for a long time. If you don't have enough cash, sell something today. Not all the way. Trim multiple positions. Don't just sell out of one and say, oh my God. So, there's no FOMO out there right now. I mean, if you got FOMO, I don't know what you're looking at. I didn't touch on crypto too much, only at the start. I will tell you, if Bitcoin gets cheap enough, I'm going to want more of it. Right now, I'm still dollar cost averaging into Ethereum. But man, if Bitcoin gets down to around 30,000, you might want to throw 20, 30% of your bank savings in there. If not going to change your life if it doesn't do anything. All right. Take care, everybody.